great Mae West once said, "Too much of a good thing can be wonderful." And that's a pretty fitting sentiment for the stock market over the past 12 months. I also think back to Jesse Livermore from the classic investment book, Reminiscence of a Stock Operator. Some of his colleagues had questions on why stocks were rising at the time, to which he simply replied, "It's a bull market, don't you know?" Well, yes, it is a bull market. And the first 6 months of this year produced very strong returns for almost any stock market investor. But that's yesterday's newspaper. It really is all about what the future holds. We will take a quick look back and then look forward as the second half of 2021 gets underway. So far this year, the S&P 500 index, an index of large U.S. company stocks, is up over 15%, and most small company indices did even better. Thus, a whole lot of stocks participated in the market surge. As for Argent, we had one of our best 6-month periods ever, and we were very pleased with matching or bettering the market's double-digit return in every strategy. Interestingly, it was the 5th straight quarterly gain of at least 5% for the S&P 500. That's only happened once before, and that was about 70 years ago. That one other time it happened, the market kept that winning streak going for 10 straight quarters. That and some other past data support the notion that robust first half returns have historical precedent to be followed by a positive second half. The tailwinds to the current economic recovery are strong and, importantly, are primarily being fed by outstanding company earnings gains. A recent study by the Luthold Group shows there is a 90% correlation between a country's earnings growth and their stock market returns. Thus, the upward trajectory for earnings in the U.S. bodes very well for the future. Of course, no road ahead comes without occasional bumps. And as we always try to remind investors, the average decline each year for the stock market is about 14%. Two possible bumps are: 1, the impact of inflationary pressures, and 2, when and how the Federal Reserve might begin reducing the massive monetary stimulus it put in place in response to the pandemic. Both questions relate to timing. For example, as to inflation, the Fed is currently asserting that high inflation is transitory. Transitory meaning this too shall pass, once the frenzy from the reopening of a closed economy transitions back to normal. Candidly, and as we have discussed in recent videos, the Fed has not convinced us yet, as there is a lot of evidence that current wage and price pressures will not abate anytime soon. As to the Fed, they have been laying groundwork for tightening by reducing their very aggressive bond buying program. With the Fed buying billions and billions of dollars of bonds, it creates excess demand, which drives interest rates down. Lower interest rates encourage borrowing, thus stimulating an economy. Once they begin reducing their massive bond buying program, interest rates should trend upward. That can unnerve businesses and consumers, and they might pull back the reins a bit and spend less. That remains to be seen, but it is something to watch closely. Fortunately, when we weigh the scales, the positives right now, particularly related to earnings growth, declining unemployment, and very healthy balance sheets for consumer and businesses, far outweigh the negative. Thus, the environment remains positive in the near term, and we are cautiously optimistic. Thank you very much for watching, and we would love at any time to talk to you about your own portfolio.